Hello, Neil Wilding. I'm one of the partners here at Stonewood Financial. And I got to tell you, this is one of those days in Stonewood's history that we are going to mark on the calendar. It's a monumentous occasion for us because we are launching the Roth Done Right uh, program. It's going to include software. It's going to include marketing collateral. It's going to include training, everything that you're used to from Stonewood Financial on a new topic, really. Well, I won't call it new. Maybe it's an expansion of some of the most popular things that we've offered to you before. Um, I know right now our most popular report is a total tax burden analysis. It's a quick, simple snapshot of someone's tax situation. If you just kept money in an IRA, and we're able to compare that to what the tax situation would be with a Roth conversion. And so some of the most common questions we got on that report, if we were looking to go in and tinker with that a little bit, one is, can we calculate the taxes on a defined level stream of income? Total tax burden just looks at the RMD scenario only. And so we had some people asking for that. And then what we also had questions on was IRMAA. We mentioned IRMAA in our training. I've had some study groups. It's been topics at Innovate, but the software didn't really address it. And so the Roth Done Right software is going to do both of those things and then some. So what I'm going to introduce to you today is we'll start with the software and then we'll get into some of the materials. But ultimately, we're going to introduce two new reports. And the good news is those two reports were created with just one wizard in the software. The first report is going to be kind of an extension of the total tax burden. What we're going to do is look at the total taxes someone would pay and the total IRMAA someone would pay on IRA money as as you assume that money as income. And then we're going to take those analysis and compare that to what the conversion taxes would be and any IRMAA that would be generated through a Roth conversion. So it's going to really help simplify, that by also adding in a little more detail to the report. So excited to show you that. And then the second report, really excited about, is we're going to dive into conversion pattern or conversion period. Question we get often is like, okay, if I'm going to execute a Roth conversion and I've earmarked, a couple $100,000 of assets for conversion, should I do it all in 1 year? Should I spread it out? We're going to introduce some concepts to you, some variables that come into play, and then ultimately deliver a report that will show you the ideal conversion pattern or the conversion period, if you will, how long we should use to execute a Roth conversion. So enough intro. Let's dive into this. I'm so excited for this to be happening. So excited I cannot click next. Give me 1 minute. Live, the beauty of live webinars. There we go. All right. So what we want to do with this software is we want to help answer three questions. One, ultimately, is a Roth conversion right for me? And by me, I mean your client. And that's really where this initial report that I talked about is going to come into play. We're going to look at the total taxes someone would pay on IRA money if we just continue to defer that money, and then the total taxes we would have through a Roth conversion. And we're going to bring IRMAA into that calculation. And ultimately, what we're doing is we're helping the client answer that question, is a Roth conversion right for me? Now, the next question is a rhetorical question because we already know the answer to this one. But how many times has a client come to you and said, well, I've got my Schwab account and I'll just do the Roth conversion on my own over in my Schwab account and I don't really need an advisor for that. Seems easy. And so this next question is like, can I do a Roth conversion on my own? And the answer is absolutely no. And we're going to introduce all the variables that come into play and really give information to your client that just says proceed with caution and make sure that you have a trusted advisor to help you in executing the strategy. I want to give you, the advisor, so much detail and so much. I'm going to equip you with everything you need to make sure that client is reliant upon you to execute that Roth conversion. And then the third piece of it is, which is the Roth conversion right? Can I do it myself? No, absolutely not. Then, all right, then let's get to work. All right, what should the conversion pattern look like? What should the conversion period look like? Should we convert over a couple of years? Should we spread it out? And depending on your circumstances and your client's circumstances, the answer can be wildly different. So let's talk about what this looks like. So report number one, what we're doing is we're calculating the impact of IRA assets on your client's tax and IRMAA situation. And I clarify here, we're not trying to calculate the total taxes they're going to pay in their lifetime. We're not going to calculate the total IRMAA they're going to pay. No, what we're going to do is establish a baseline of income. And then once the IRA hits that baseline, what is the additional tax and IRMAA that you're going to have to pay because of that IRA money? And so the analysis is all going to be based on the IRA. It's not your total picture. Now, we're going to need some details, and you'll see that here in a minute, in order to make that calculation. But the report itself is looking at the impact of IRA assets on a tax and IRMAA, which, by the way, is one of the main things we need to be looking at when considering a Roth conversion. And so what do we have? We're trying to answer that ultimate question, should my client convert these assets? And so we've got tax and we've got IRMAA, and we're going to calculate both of those. And so, but we're going to do it in really 3 different scenarios, because your IRA money, if you just keep money in the IRA, well, it might have different purposes. Like some people plan to use every penny of that IRA as retirement income for themselves. Other people might say, well, this portion of the IRA is going to kids, it's legacy, but we still have to take RMDs on that. So the liquidation of the IRA in that scenario would be through the RMD process. So what we're going to do in this analysis is we're going to calculate both. And then we're going to compare that to a Roth conversion. So we're going to take your client's taxes and IRMAA, and we're going to calculate how much would my tax bill, my retirement tax bill, and my IRMAA surcharges, what would they be if we just go through the RMD process? And so that's going to be for those folks that this portion of the IRA is going to kids, or maybe it's a maybe. Like I might use it, might not, but more than likely we're going to defer this as long as possible. I don't want to pay tax, right? Like how many people say that? I don't want to pay tax. And so we'll just push that off as long as possible, and we'll just liquidate this IRA through the required minimum distribution process. So we're going to calculate total taxes, total IRMAA in that situation. But again, that's just one way that we're looking at this. The other way we're looking at it is through level income. And so we've got a calculator that's going to just say, okay, whatever your IRA assets, you're going to tell us in the input process how long you want to show that income pattern to be, and we'll just calculate the systematic withdrawal pattern that would liquidate that money over that period of time. And then we're going to calculate the total tax and total IRMAA in that way. So now you've got your IRA, and it's either we're going to access it through the RMD process or through level income. Now, what are we trying to decide, right? We're trying to give our clients alternatives. Well, the alternative, instead of just deferring that money, keep it in the IRA, the alternative is Roth conversion. And so we're also going to calculate, okay, what would the conversion taxes be? And then are we going to trigger any additional IRMAA surcharges if your client's on Medicare during the conversion? Let's bring that in, and we're going to be fair as we can and make sure that we calculate everything based on a set of inputs and looking at these 3 scenarios. Now, what you'll see here is that we're going to ask for a little bit more in the input process this time. If you're familiar with total tax burden, we just ask you, what's your client's effective tax rate? And you just have to put in there 15%, 20%, whatever it may be. Well, we're going to go a little further here, and we're going to calculate that for you now. So we're going to have to ask what the client's current income situation is if they're working. And then we're going to have to ask them, what the projected income is going to be in retirement. Do they have Social Security? Do they have, when do they plan to elect Social Security? Do they have other IRA assets that won't be converted? Do they have non-qualified money that they may have as income, like if they're going to continue working even after they elect Social Security, or maybe they have some rental properties or something like that. We're just going to use a catch-all box for that. And I know the taxation of those assets can vary a little bit, but we're in the Stonewood spirit. We're trying to create a simple report. It's kind of a big picture analysis, and so we're just trying to make the input process as simple as possible. And then based on everything you tell us, we're going to calculate what their effective tax rate is today. Um, we're also going to calculate then what the effective tax rate will be during the conversion. So if we have any tax drift, if we have any other things affecting our taxes during the conversion, it will reflect in the results. And then also we've got some inputs in here around IRMAA. And the IRMAA surcharges. And by the way, IRMAA is proving to be a great content provider. It is, you start talking about, with Stonewood, we talk about legislative risk. IRMAA proves to be an ultimate example of legislative risk. People don't think about IRMAA as a tax, but it's absolutely a tax. And the higher that IRMAA goes, the less money you have in your pocket if you're forced to pay those surcharges. And the challenge is, it's already written into law that those surcharges are going to go up every year between about 4 and 8%. Last year it was 5.9%. Every year is going up. And so that we're going to make that an input and say, if that can happen, if those IRMAA surcharges go up, we need to bake that into the calculations. So anyway, you can see here the input process. We're asking a few more questions, but we've simplified the wizard. You're looking at the output page of the report here. When book some time with our team, we can show you the input process or dive in as soon as it's over. You can see how we've simplified the wizard. It's really not too taxing. Sorry, terrible pun, of a process here. You'll be able to get in and out of this very quickly. All right, so those are the inputs, right? So we've got a client, we're trying to calculate the impact of my IRA, and in this case, I think we went with 500,000. The impact of my IRA on the total taxes and total IRMAA I'm going to pay. All right, so step one is let's calculate what the total taxes would be if we just took level income. And you're seeing this unfold in PowerPoint, but this is a report that we've built for you. So what are the total taxes? Now, I think in this client, we're looking at, I think they might be 60 now. We said retirement would be 70 to 95, I believe. So 26 years of income. That's 53,000 every year, and it would liquidate by that time frame. So the total taxes on that would be $349,000. I don't know if you paid attention. I created the assumptions to where this client has about a 20% effective tax rate. That includes federal and state. So $349,000 with just through taxes, through income taxes. But this client, I think I made him a single filer, so he's going to be paying some IRMAA. So $30,000 of IRMAA, and your total tax bill would be $379,000. And this is on 500,000 at about a 20% effective tax rate initially. And of course, my assumptions would change that. All right, so now we say, well, wait a minute, level income doesn't really matter. This is a part of the IRA that's going to the kids. I don't really want to pay that tax. It's not going to be that bad for me because I'm just going to go and do my RMDs. Well, if we go through the RMD process, hate to let you know, your tax bill actually goes up. You pay a lot more money through the RMD process in taxes. Why? Well, I know it bucks conventional wisdom here, but we're deferring taxes further into the future. And of course, all of that growth is also deferring taxes into the future. And so by the time we go and access that, we actually pay a lot more in income tax. In this case, $473,000. Now, I think in this example, I synced it up where the IRMAA is the same, but in a lot of times the IRMAA amounts will be different. And we can see that in different ways. And we'll talk about that as an input variable here in a minute. But in this example, another $30,000. And by the way, that's not total IRMAA. That's just the surcharges you pay because of the IRA. So we got an extra $500,000 coming into our income over time That's going to trigger an extra 30 grand over your lifetime in IRMAA surcharges. Total tax bill, $503,000. Now, what's the get out price, right? What if we do a Roth conversion? Well, if we do a Roth conversion, my total tax bill is going to be $126,000. Now, this is 500,000, right? And if we just get it at the 20% effective tax rate, that'd be a, what, 100 grand. So we're paying some drift here. Oh no. Oh, should we pay tax drift? Well, we're actually able to get this out of the way without having to pay any additional IRMAA surcharges. So your total tax bill is 126. So you tell me, you want to talk about going through a conversion process of paying 126, or do we want to go down the path of paying 380,000 through the level income process, or even more if we're just going to take required minimum distributions? So already we've got a very compelling case when looking at tax and IRMAA that we need to convert this money. But I'm going to make two changes. And by the way, before I kind of jump the page, as I mentioned, this is just built in PowerPoint for me to be able to show it to you. This is a report. And this is, there's to be some copy to help introduce the concept, and it's going to get to this page here, which paints that picture for you, right? And this is what the output actually looks like, and it shows exactly what I just unfolded here. Choice one is to keep the IRA and either liquidate it through RMDs or level income. Choice two is to go through the conversion, and you see that data there. Now, let's get into making sure the number on that report is accurate. So now I'm going to get to that, where I'm going to make two important changes. And I'm going to show you the results first. I'm going to go a little backwards here. So the report used to look like this. And then I made two changes, and now it looks like this. And so suddenly my tax bill is over all in through the RMD process is 760,000. And look at that IRMAA. It jumped from 30 all the way up to 144. Now, what two assumptions could I change to severely impact the results of the report? I'd take questions from the audience if I were live here, but well, I'm live, but I meant if I were on stage. And I'll get to some of your questions here at the end if I can. But the first thing I did is I modeled a tax change. So if you looked at the assumptions I put out there initially, I just assumed that all taxes always stay the same, and that effective tax rate at 20%. I think it was like 18 for federal, another 2% for state, something like that. I don't remember. But then what I did is I modeled some tax changes, and I assumed taxes changing in the 7th year, and I assumed them increasing by 30%. Now, where did I get those two numbers? Those are assumptions. You can put whatever you want into the software. I chose 7 because I assumed a 5-year extension of the Tax Cuts and Jobs Act. We're already in year 1, and so then you get a 5-year extension. That gives me 6. And so that means in the 7th year, we'll do my fingers here, 7th year, does that help? The 7th year, that would represent a higher tax rate for my client, so I modeled that. And then I use 30% just because we have some data that suggests for the average American taxpayer, if taxes just went back to where they were a couple decades ago, it would actually require a 30% increase. So I just modeled that. That's the risk we're trying to present, kind of protect against. So that's where I came up with that 30% number. But I also made a second change. And the second change is around IRMAA and those surcharges you got to pay. And as I told you, that is the gift that just keeps coming to advisors trying to differentiate themselves in this marketplace. If you can really get your hands around IRMAA and how it and build into the language that you use with your clients on how it truly represents legislative risk, and it's actually legislative risk that's already been passed into law. And so if we model in even a modest increase, as I mentioned, historically the numbers have been between 4 and 8% per year going up. Actually, since 2019, the number's been north of 7. Now, last year, they did us a favor. It was only 5.9. But we need to model that. And so I assumed a 6% increase of IRMAA into the report. And that's why just that 6% increase That's why that surcharges, lifetime surcharges went from 30 grand all the way up to 144. And so when we look at use cases of the software, I mean, it's one thing to go ahead and run a report and get a baseline. But then when you go in and change some of these variables, and it can really highlight the risk that our clients are subject to if we continue to defer taxes to the future. And IRMAA is just one of those examples. And the report is going to highlight that. And so here I am, I'm just showing those two on the same page here. Just changing taxes in the 7th year and showing that increase, which is really just what historically the increase has been. Suddenly, we certainly need to look at conversion. Now, you might also notice the conversion number went up. My tax bill went up to 136 from 126. Well, that's because in this example, I think I spread out the conversion. I think it might be like an 8-year conversion, but we're going to talk about that one here in a minute, because if we don't want to, be subject to a tax increase in the future, maybe we convert that money a little quicker. All right. So by the way, these are the pages I show here. This is the general output that we have. But every number in that report is backed with tabular data. So we'll be able to slice and dice this however you want. For your engineer clients, you're going to have all the tabular data that you need to kind of back up that high-level summary. Although for a lot of your clients, we're just going to need, like that one page to just kind of paint that quick picture of what the tax situation would be if we just continue to defer money, and how the get out price is actually extremely attractive. Okay, so that is the first question, which is like, all right, do I need to convert? And, that part of the report says absolutely. But then this question comes up, and I talk to all of you, so many of you. And one of the common things I hear is like, there's always these do-it-yourselfers out there that just think, I got this, Schwab account, or I got my online brokerage account, whatever it may be, and I could just do a Roth conversion through them. I don't need an advisor for that. And while mechanically that's true, boy, this is not a decision I would recommend doing alone. And here's why. And this is my goal, is to make you the trusted advisor in your area that's expert in all this stuff. And maybe you're already expert and you just want some data to show it. But that's what we're going to do here. Is I'm just not going to accept anybody doing a Roth conversion without talking to one of you first. The variables that I want to bring into consideration first is tax drift. And that's, that's what it's on everybody's radar. And I get it, right? We certainly want to think about tax drift as a potential risk in a conversion. Obviously, if we're converting too much money too soon and we're driving up income, and pushing our clients up 1, 2, 3 tax brackets, that could be a problem. And so we need to quantify that. So of course, we are going to bring the fact that drifting into new tax brackets could represent risk for our clients. We're going to bring that into the equation. But don't be foolish and think that's the only variable. What about conversion delta? Now, I'm guessing you haven't heard that term before because, well, frankly, we made it up. But it's a concept that needs to be brought to light. And I think what you're going to see here is that conversion delta, once I define it for you, is going to work directly opposite tax drift. And while tax drift is telling us, oh, let's slow this conversion down as much as possible, conversion delta is going to be the opposite. So conversion delta is the risk that taxes change during your proposed conversion pattern. So let's just say, you know what, I want to spread this out 10 years. I don't want any tax drift, and so I'm going to take this 500,000 and I'm just going to convert 50,000 a year for 10 years. Well, that's great, but if taxes change in the 5th year and the price of conversion goes up in the 5th year, would we have been better off converting all of those assets before prices went up? Yeah. Well, conversion delta puts an amount on that. It puts a dollar amount on that. It quantifies the risk of taxes being higher the later years of our conversion pattern. And that's an important variable. And so we're going to help you, bring that, shed some light on that. And then the third piece of this is IRMAA. And man, IRMAA, Now you might think, well, IRMAA works like taxes, right? So if I'm, if I'm on Medicare and I'm paying the surcharge today, boy, I might want to spread this conversion out as much as possible, because not only do I not want to jump into a higher tax bracket, I could be in a higher IRMAA bracket too, and you're hitting me with a double whammy. True. But what if you're not on Medicare yet? What if you're, 3, 4, 5 years out from even Medicare hitting your income plan, right? Or hitting the radar for when they start calculating the surcharge? Well, in that case, you might want to speed up, right? So do we speed up? Do we slow down? Can you see what's going on here? And in the training, I bring in like a speedometer imagery here. And that's really what's in play, because if we're only worried about tax drift, we might back off the gas a little bit and slow down. But if we're worried about delta and taxes changes, boom, pedal to the metal, let's go fast. And if we're worried about IRMAA, well, it kind of matters. Should I speed up? Should I slow down? I don't know. Can you see here what's going on? We're trying to give you terms here to make sure that the client, like, you got your hooks in them, where they absolutely need you to go through with this Roth conversion. Because the final piece here is putting some data behind this. So when you go to run the report, in that same wizard that kicks out that other report, it's going to kick out some additional data and say, okay, based on various conversion patterns, we're going to look at if you convert this all in 1 year, and we're going to spread it out all the way 10 years, and then every pattern in between. And we're going to say, okay, if we go with 1 year, you're going to have some pretty heavy tax drift. But if we spread it out 10 years, not as much of an issue. But then we got our conversion delta column, right? And that's opposite. And you see those zeros in there as far as conversion delta is concerned, because there's no impact until taxes change. And so I showed taxes changing in the 7th year. Well, that's when the delta hits in, if we're going to convert that over 7, 8, 9, 10 years. Okay. And then IRMAA, who the heck knows, right? Because it's all based on how old your client is, when they're electing Medicare, if they're going to do it when they can at 65, or if they have some opportunity to defer it. And remember, oh yeah, there's that 2-year deal where, when we calculate IRMAA, we're looking back 2 years. And by the way, if a lot of you have really come to understand IRMAA, if this is rather new to you, fear no more. We've got all sorts of training modules to help you incorporate this into your day-to-day conversations. But the point being here, all 3 of these variables are working against each other. And so we got to bring them all together. And that's the next piece of this. I say, okay, based on everything we know, or at least everything that we project, based on tax drift, based on conversion delta, based on IRMAA, you tell me, what's the right way to go here? How quickly should we convert this? And you can see here, the answer is matters, right? We definitely don't want to do it all at once, because that's a heavy tax drift. So if we do a 1-year conversion, $267 is my all-in tax bill. By the way, still significantly less than deferring or going through the RMD process, but still not the optimal pattern here. And so what you'll see here is some different variables in play. And what I see here is the ultimate, the lowest number on that is 3 years, 212,000. But what's interesting to me, I look at 10 years, and a lot of people think these conversions you should spread out as far as possible. And you actually could. The data suggests if you wait 10 years, I'm not saying wait 10 years to convert. If we convert this and divide it up into 10 mini conversions over 10 years, that's a pretty low number too. But which is ideal? What you tell me? What would you rather have? If both of them are 215,000, and I can do it in 4 years, or I can do it in 10 years and pay about the same amount, which is better? Now I would argue, let's do it quicker, because what are we doing here? Like, why are we considering Roth conversion in the first place? Because we're worried about the increase of taxes in the future. We're worried about the fact that the cost of my IRMAA surcharges go up every year. Well, I'm going to look at this report and say, what's the quickest way I can get out the door without really penalizing myself? And so in this one, 3-4 years really is the answer. So this is what the reports look like. You can tell I'm fired up about this. You go through the wizard based on, we're going to ask you some questions about your client. And it's going to kick out a report to tell you whether conversion makes sense based on your tax and IRMAA situation. It's going to kick out a supplemental report that's going to show you what the optimal conversion pattern is. And we're off to the races here. Now, what you might be thinking about is, okay, great. How can you make me look different in my seminars and my marketing and my client conversations? Well, part of your Stonewood membership includes marketing collateral. And so we've got new stuff that we are bringing out as part of this launch. The first is an update to the seminar. Now it's Washington in your retirement. It looks a lot like the legislative risk seminar that we have out there. But what we've done is we've taken IRMAA and plugged that right into that same concept. And so we use that as an extension of the legislative risk conversation. I'm telling you, some data points on IRMAA make for really great content. And when people hear that in a seminar setting, they have no choice but to book some time with you, because you got the report now that you can say, hey, just let's see what your numbers are. Right, but that's a full seminar. Now, what other people like to do is just kind of take modules, and so we also have just an IRMAA module to where if you've got a seminar that's working well for you and you've got your rhythm down pat, but you just want to kind of plug in a few slides, that's what the module is going to let you do. And so we got some slides on that, and that's live in the system as of today, right? Like you can log in and get those now. Not just seminars though, I authored a white paper. I think if you tried to grab that now, might not be there yet, but it will be certainly here shortly. I'm making some, working with the marketing team, make some updates on that. But we'll have a white paper that is a client-facing white paper that addresses all of these variables, like the tax drift and the conversion delta, and IRMAA, and how all of that should help. You know, we need data to base our decision on conversions, right? And so that white paper helps with that. We've got a client brochure, client videos, and oh, by the way, training, right? We don't just push you out there and say you got to go. We've got training videos that you can access. And of course, our team is here around the clock for you for one-on-one calls on how to incorporate this. So it's at that point where I was going to wrap up, but I thought, you know what? Let's do this. Let's just get one example. And I just want to show you how to use this. And I had fun with this one. It is just because we're giving you, it's a level of analysis a lot of people haven't considered before. And so let's just play around with this as an example here. I've got a 65-year-old couple. They're a small business owner. They've got a $1 million IRA. They're 65 now. They're going to be retiring in 5 years. So they're going to defer Social Security. They're going to defer retirement until 70. But at that point, they're going to elect, by the way, they're going to go on Medicare 65 when they can. I just assume a 5% growth rate. You'll notice here, as I said, there's a lot more inputs that we need. That just helps us calculate what their effective tax rate is today, and it helps us get to whether we're paying any drift or not along the way. It's just important details. All right, so in this case, the $1 million IRA, they're going to live off of that. And they got their Social Security and they got their IRA. And they're just considering a 10-year conversion because they're worried about tax drift. So they want to spread this out as much as possible. All right, so what are the results here? Well, initial results are, like I said, if they're going to live off of this, your total tax bill would be that level income line. That's $512,000. We can get out the door on a Roth conversion for $272,000 of income tax. Now, it does trigger some IRMAA surcharges. And so this report's going to show this a little bit. And so then it's going to be a matter of talking to our clients and seeing if it makes sense. Because like I look at this and I think, all right, 30 extra thousand in surcharges that I wouldn't have had to pay otherwise. I don't know if I want to do that. But you look at the total, we're like, well, 302,512 for sure. Let's go forward with it. But some people that might be the objection to the conversion. And so that's why we're going to look at this and say, all right, let's look at the tax drift impact here. Let's look at conversion delta. And then we can look at that IRMAA and say, does it make sense to do this or not? And you'll notice that $30,000 number on IRMAA comes on a 10-year conversion. But actually it can be a little higher if we go faster. But there is something you could do. And I have a friend of mine that works in the industry on the Medicare side of things. And I just asked him, I said, is that something people do? Like, do people defer Medicare? And they said, well, yeah, in some cases, it just matters how much, like it costs you to buy insurance if you're still working and you still have access to a plan. So like, there is some things we can do there where we can make that IRMAA go from 30,000 down to 12,000 in this example, just by pushing back the election of Medicare. Now, I'm not going to harp on that one because I know, most people access their Medicare at 65, but that is something that's out there. But I'm going to change the example significantly here. How many of you are small business owners? Actually, I know most of you are, right? You're advisors, you're running your practice. Um, how many of you get to the point where, you know what? I don't really want to retire. I love what I do. I love my clients. Just because I'm taking Social Security now, I'm going to keep working. Um, well, in that case, boy, does IRMAA really rear its ugly head. And that's where I'm going to change my example here. Is I'm going to go from someone, instead of using that IRA to live on, we're just going to say, you know what, don't need that IRA because we're going to keep working. And in this case, it's 250 grand of income that will be coming in the door as part of the business. And we're going to just keep working. And but the IRA is going to just go through the RMD process and ultimately go to the heirs. Well, now, remember, these were my numbers if I actually retired. And so this was the report from before. Now, the one change I made, which is, okay, now we're going to keep working. And so if we continue running the business in retirement, look at those IRMAA numbers. My tax situation went up too, by the way. Why? Yeah, right. You're making the connection here, right? So look at this. So if we just continue running the business and that IRA just stays there and it continues to grow and grows. And now because I'm working, I'm in a higher tax bracket, and now I've got Social Security mixed in, and I'm still making all that money from the business. I talked to so many of actually financial advisors as business owners where I wanted to keep working. And now I'm paying a heck of a lot more IRMAA surcharges. And in this case, your surcharges are going through the roof. And so where it was absolutely something that we wanted to do before, now it's an open and shut case. Like if you're going to keep working, you're going to pay some IRMAA. And that can have some significant impact to the results. Now, and so kind of as I mentioned, if we're leaving the IRA, the RMD process is the line that matters there, right? So that's 1.3 million. And if we convert, we're 363. Like, I'm not great at math, but man, that's almost 7 figures of savings. You think somebody might want to talk to you about that? Yeah. See, this is the value of bringing IRMAA into this conversation and understanding the levers to pull when we're running our reports. It's not just about your current situation, it's what could be. And if we could continue to work, man, we really need to look at Roth conversions here. All right. Now, here's the other piece of that. Is that's assuming a spread out conversion. I think I had 10 years. Well, when I run the report, the ideal conversion pattern is actually going to be much quicker. It's going to be either 3 years or 5 years. And so I went in and just reran my numbers. And so if I'm on a 3-year conversion, I might want to do that really quickly because maybe I can avoid IRMAA altogether. But still, my tax bill is a little bit higher because I got some more tax drift going on. Or if my client is laser focused just on give me the best deal possible, well, maybe that's a 5-year conversion in this scenario. Where look at that, man, that 317, we actually got that under the 334 number. So that means, my simple-minded math, we're actually saving this client a full 7 figures in taxes and IRMAA by making a conversion. Man. Let's do some work. All right, so now question for everybody is like, okay, what are you going to charge me, Neil? This is new software. I want to use it. What are you going to charge me? Now, the good news is this is a preview of our software. It is live in the system, and everyone on this call is already a Stonewood member. And so now the answer to that is kind of matters, what membership you have. For those of you that have our Premium Plus bundle, you already got access to this. If you logged in yesterday at 2 o'clock Eastern, you would have seen it. And we actually had a few people go in and run some reports before they even knew what they were doing. So if you are a Premium Plus member, you already have access to it. Now, I know we have some other people that came to us through like an annuity membership or maybe an IUL membership. those of you will have to decide if it makes sense to upgrade, because you do have to have that Premium Plus bundle in order to get access to this report. But for that, it's just an extra $100 a month. And if you're on an annual plan, it's even less than that. So, boy, hopefully I've lit a fire under you and you're excited about using this new tool. The QR code on your screen there is a direct link to coaching calls with our team. And if you already know that you're a Premium Plus member and you just want to learn more about how to use this stuff, book some time. If you know you have an annuity or an IUL membership, or you're just not sure what membership I have, just book some time with the group, and they will walk you through, what membership you have and if you need to upgrade or not. But more importantly, get you access to these tools so that you can. I'm losing my voice. I'm so excited about this. So I encourage you to go in, dive into this, use the reports, and then I'm the most excited about seeing how you all are going to use it. I just came up with a couple of ways here, but let me know. Oh man, Neil, I'm going to use this to have this conversation with my client, or that one, or this is a variable that I'm going to change to where I can really play with results and motivate my clients to do some business with me. So however you plan on using it, please let me know. Like I said, I'm excited to learn about how you all are going to use this. As always, thank you so much for being a loyal member, and I'm excited to see what you got for me. So thanks, and have a great day.